Hello, good morning, or good afternoon, everyone, or good evening, depending on which part of the world you're at. Welcome to the FMI broadcast number 6. We're happy you're joining us today. I'm Carlos Leon, and I'm your usual host in this series of FMI broadcasts. We're going to give the audience a few minutes to log in and join. Okay, it's 3 minutes past the hour, so right now we're going to do some housekeeping. As most of you know, the FMI broadcast follows a 60-minute format in which our guests will provide expert insight into the latest developments and innovations influencing the industry today. Please use the Q&A widget below to ask your questions. Speakers will aim to answer as many as they can during the 10-15-minute question and answers part at the end of the webinar. Please do not forget that Chatham House rules applies. Today, as I mentioned, or I'm going to mention for the first time, the topic is the relevance of liquidity savings in real-time world. First, some words about FNA. FNA is a leader in advanced network analytics and simulations. FNA software is used to uncover hidden connections and anomalies in large, complex datasets, to predict the impact of stress events, and to optimally configure financial systems and infrastructures. FNA is trusted by the world's largest central banks, financial market authorities, and government authorities. About FNA solutions regarding the FMI lifecycle, what I want to tell you is that we provide advanced network analytics and simulation solutions for financial market infrastructures. In this FMI lifecycle that you're seeing on the screen right now, we have two sections, the building and the operating and the overseeing. In the building part, which is like where all FMIs start, what we propose, or the value proposition that we have for you, is reducing the design and the validation cost while increasing the effectiveness of those solutions. Second, increasing the effectiveness of attaining regulatory approval and member engagement. Third, going to the operating and overseeing part, to improve the regulatory compliance and oversight and manages the risks related to FMI functioning. And fourth, at the end, optimizing systems, design, and parameters to reduce risk and increase efficiency, which is something we're going to talk about a little bit later today. So now we'll have our broadcast speakers. Our first guest is Richard Dzina, Senior Vice President of the Clearinghouse. Richard joined the Clearinghouse in 2020 following a 28-year career with the Federal Reserve Bank of New York. He has product responsibility for the Clearinghouse Interbank Payment System, very well known as CHIPS, which is the largest private sector dollar clearing and settlement platform in the world. Richard received his Bachelor of Arts in Political Science from Princeton University and his MBA from Columbia Business School. Thank you, Richard, for joining us today.
Great pleasure to be here. Thank you.
Thank you, Richard. Our second guest speaker is Stephen, and if you allow me to not to say your last name, and you're going to tell us a little bit how to pronounce it afterwards, I'm going to introduce Stephen, who is Senior Principal of Product Management at BNY Mellon. Stephen is responsible for the development and delivery of dollar clearing services. He's a Chairman Emeritus of the BAFT Payments Committee and a former Dean of the Payments Institute. He joined BNY Mellon in 2019 after holding leadership positions in risk and product management at Deutsche Bank and HSBC. He has held a variety of roles at SWIFT, including sales and market development of file transfer and FX trading matching services in North America. He received his Bachelor of Arts in Economics from Rutgers University and his MBA from Wake Forest University. Thank you, Stephen, for joining us. Now, before we start, a very brief summary of what we're going to talk today. We all are very aware that the payments, either wholesale or retail, are rapidly heading to real-time processing. Real-time is a word that we hear every day, practically. This is particularly demanding for financial institutions and financial infrastructures that work on liquidity saving, and liquidity savings are becoming elusive for that reason. Further, the current monetary stance makes liquidity very scarce and costly. So the idea today to introduce the topic is what we're going to discuss is what challenges are financial institutions and infrastructures facing amid this push for real-time processing during an abrupt quantitative tightening that we are living today. And that's why Richard and Steve, you're with us today. So once again, thank you for joining us.
A pleasure to be here, Carlos. Appreciate FNA's kind invitation to speak to your broadcast today. It's a great privilege to engage with your community, which we know on these subjects is as informed and as knowledgeable as any in the industry. It's also great to be joined by my friend and colleague, Stephen from Boney. And I also am looking forward to the lesson on how to pronounce his last name. In fact, it's a privilege to be on the panel with someone whose last name is more challenging than my last name, but be that as it may. But by way of background, with the Fedwire Fund Service, which is operated by the Federal Reserve Banks, CHIPS is one of two high-value payment systems in the United States. In many respects, CHIPS and the Fedwire Fund Service are complements to one another, most significantly in their management of liquidity. The Fedwire Fund Service, of course, is a pure real-time gross settlement system in which all payments must be funded with balances in a master account of participants at the Fed or reliant upon the Fed's daylight overdraft provisions, with all payments settled on a gross basis in real time. CHIPS, in contrast, has a very sophisticated liquidity savings algorithm at its core that continually offsets and matches payments in queue with great efficiency, with only the net settling across participants with immediate finality. The algorithm is CHIPS' distinguishing attribute, and we believe its comparative advantage. Presently, we are settling approximately 1.9 trillion in value every day on a funding base of about 65 billion for a daily liquidity efficiency of almost 30 to 1, meaning that $1 contributed in funding supports almost $30 in settled value. We believe it is the most powerful and efficient liquidity savings engine in the world, and one that delivers substantial value to our participants, to financial markets, and to society at large, and look forward to expounding on those themes in today's broadcast.
Thank you, Richard. That was a very comprehensive summary. Steve, something you would like to introduce yourself with?
Yep, I'm Steve. Now, I say my last name, Wojciechowicz. It does have a lot of extra letters that are in there. Polish people tell me, though, I'm saying it the wrong way, but that's how we say it in America. We say Wojciechowicz. I am one of the product managers for funds transfer here at BNY Mellon. Liquidity for BNY Mellon is a broad topic, and it crosses all of our lines of business. As it relates to funds transfer, though, generally, when we talk about intraday use of funds transfer is what uses it because of what Richard had pointed out, the finality of the payments at the time that you execute that transaction. So we spend a lot of time thinking about intraday liquidity and the use of funds. I think the key element, and I think we're going to talk about this as we go through the panel, when we talk about liquidity, it's not so much about having money, it's about having money when you need it. And it's that timing element that's really vital. And I think that as we explore this topic over the next hour or so, we're going to see how the changing landscape of payments has a real impact on that timing. So I'll turn it over to you.
That's great. That's a great introduction from both of you. I was going to start everything to break the ice, like asking you what is your work, how is your work related to liquidity management? But I think you already did it. So I'm going to skip the first question that I had. But if you have attended the previous FMI's broadcast, I always love to make like a very short wrap up every time you have an answer. So my wrap up here is liquidity is important, but liquidity is something that we have to define very well. And we know in risk management that liquidity is many things. But right now, what we're going to talk today is more about intraday liquidity management. That's like the main topic, but obviously it's related to other kinds of liquidity, but the main topic is intraday liquidity. And in intraday liquidity management, the key element is, as you mentioned, Stephen, is timing, synchronicity of the payments, to have the money when you need it, and that's it. And not to have idle money in your balance. That's the whole point. So let's go to the second question. In my view, right now, there are two forces pushing for more efficient liquidity management. First, there's the push for a real-time world where everything is expected to settle immediately. And we're talking about retail and wholesale. It's not only wholesale, it's retail as well right now. Second, we're experiencing the steepest quantitative tightening in about 2 decades. How have these two forces showed up in your daily operations? Let's start with Richard.
Well, Carlos, I think those are both very astute observations. As you note, the push for real-time payments in a real-time world is a galvanizing one across the industry. It touches every facet of the payments ecosystem and holds great promise for end users in particular. But it also puts great demands on banks and elements of the chain with respect to their stewardship of liquidity. And as such, we think that chips will continue to have a very important part in the landscape going forward. The second factor that you note, of course, is quite topical. We are, as we all know, in an unprecedented tightening cycle, especially with respect to the speed of that tightening. And I will suggest that an environment of rapidly rising rates and quantitative tightening underscores the value of liquidity savings and the CHIPS algorithm for both participants and the financial system generally. We look forward to expounding upon those themes in discussion today. I will note that this environment is having a direct impact on what we are seeing in our flows presently. The volume that we have seen on chips recently is absolutely increasing. In Q3, our chips volume and value were both up about 4%. With corresponding increases in market share. And I would just note that with that increase in volume also comes increase in liquidity efficiency, because there's very much a virtuous cycle, if you will, in which volume increases on chips, both through simulation analysis and exhibited empirically, tend to increase liquidity savings. So it's a very dynamic environment which we're presently operating, Carlos.
Thank you, Richard. Steve.
So, Carlos, there's one other element of, I think, the overall industry that has an impact on liquidity. I mean, your 2 points are absolutely valid, as Richard's highlighted here. But the other change happened a few years ago, but it's still got an influence on us. And because liquidity is becoming more dear, it has maybe a magnified impact. So let me just, there was a change, and this was a number of years ago, in the way that banks were regulated when they evaluate the deposits that we have. So when we get money from a client, that's a liability for us, right? That's money you gave to us that we got to give back to you at some point. And from a regulatory standpoint, regulators are concerned that you have that money at the time that the depositor comes back in and asks for it. right? Because our whole shtick as a bank is we borrow money and lend it to somebody else. Well, that BIS did a recommendation, and many jurisdictions adopted their recommendation on the treatment of those balances. Now, one of the key concepts of the way to determine your balance, or how much money you have, or how sticky that deposit is, how likely is that deposit going to stay on your books, is a view of how often your client uses it for payments. And when we evaluate the balance, we try and determine what is, we call it operational. So if your client's making a lot of payments at a certain amount, you need a value, you compare that value to the amount of money that they have in their account. And if those equal, on a daily basis, they're going to use $1 million and they keep $1 million in the account, then that $1 million is treated as operational. That's good. That means that we can lend that money out. It's very likely the client's going to keep it in there because they need it. They're going to need that money. They're not going to come back and ask us to take that money out and put it someplace else. Now, if it's over $1 million, like their balance ends up being $10 million, that $9 million, that's not so good. Because the way the regulator looks at it, they're going to say, that depositor doesn't need that money to make payments. They're going to take it. They can take it at any point. So you as a bank need to treat that differently. Maybe you can't lend all that out. And then that's less value for us from a liquidity standpoint. Today's environment, where liquidity is becoming more dear, makes us have a pinpoint focus on those operational deposits. We really need to make sure that we balance how much money a client has. So the things that have changed for us more recently as rates are rising are twofold. In addition to looking at this, well, maybe it's threefold because I just talked about these operational deposits, but the other thing that we need to worry about, clients now have peaks and troughs in their flows. There's days when it's busier and days when it's not busy. But we're telling them, look, we only want you to keep $1 million in that account because that's the good balance. On days when they have a peak, when they need more than $1 million, now we have to come up with creative ways to lend them money. Hey, we don't want you to put that money in that account, but we know you might need money on a certain day. So we'll let you borrow with the assumption that you're going to give that money back to us. You're going to be able to fund your position by the end of the day. So that's one aspect. The other aspect of it is what Richard had talked about, that use of idle funds. Now, how are we going to make use of balances that aren't operational? What can we do with that? So we try to come up with creative ways that a client can keep a deposit with us, and maybe we move it off balance sheet. Maybe we can invest that in a mutual fund someplace else. Maybe we can keep that as collateral against a loan that they might need. Maybe from an operational standpoint, maybe actually they don't need to keep as much. Maybe they don't need that $1 million. Maybe they can keep half that amount, as long as that we've got collateral someplace else that we can leverage to ensure at the end of the day that they've funded their position. Does it make any sense?
Yes, it does.
Okay, so those are the things.
I think that's very interesting, because those type of peaks and drops that you talk about, it makes me think if the velocity of money, I mean, that's coming from like monetary policy or monetary theory. Normally you assume that the velocity of money is constant, but what you see obviously from a banking perspective is that velocity for each client is different, and for each client it changes a lot, and obviously that's demanding for the bank and obviously for the financial market infrastructure to be able to manage those peaks and those drops, because that's the whole point of it. I mean, just to have enough balance, not to have idle balances. So that's the whole point of it. So it's very interesting. Richard, when we had a chat a few weeks ago, you mentioned that the relevance of liquidity saving mechanisms is becoming more and more prominent as we emerge from an era of low rates and glut of collateral. That's something you already started pointing out. Can we further elaborate on this?
I'd be delighted to. Even before doing so, let me just say that I knew I would learn something myself in today's discussion. So appreciated Steve's elaboration on the regulatory component as a critical consideration with respect to liquidity savings, and he presented that just marvelously. So thank you, Steve. With respect to the benefits of liquidity savings in that current environment that you referenced, Carlos, I think I'd like to highlight maybe three dimensions, three themes, all of which I think are becoming even more relevant today. First would be economic cost savings. Second would be financial stability benefits. And third, the benefits that derive from earlier settlement from liquidity savings, which yield tremendous value, we believe, in customer service and in operational risk reduction. But let's start with the most traditional and I think well-known economic benefits of liquidity savings. As Steve just noted, liquidity is expensive. The opportunity costs to banks, in particular, of holding reserves to support payments in a real-time gross settlement system versus conserving liquidity via an LSM and holding a loan are substantial and growing. And in the current environment, we have conservatively estimated that the annual savings to the industry from liquidity savings is approximately $2 billion per year. So quite a substantial value. But as significant as that may be, I want to suggest that in the current environment, it may pale relative to the financial stability benefits of liquidity savings. As we all know, aggressive tightening cycles tend to expose latent fissures in the financial system, like fault lines between tectonic plates. One never knows precisely when or where they may break. We also know that liquidity is ephemeral and tends to evaporate when needed most. In that moment of crisis, therefore, we believe that banking participants, CHIPS participants, are best positioned to support their payment obligations and those of their customers in a very volatile environment. Finally, I would just underscore and note the value from liquidity savings that derives from earlier settlement. We know from the past analysis that has been conducted that activity on chips tends to settle about 5 hours earlier in the day than activity on the Fedwire Fund Service. The median settlement on chips, meaning 50% of volume settles before it, 50% after, is about 8 a.m. in the morning. The corresponding median settlement time for the Fedwire Fund Service is about 1 p.m. in the afternoon. That earlier settlement, we believe, delivers substantial value to participants and end users in their ability to recycle liquidity, and also supports reductions in operational risk, given that more activity is settled earlier in the day and is not queued up for the end of day, where it could have more operational risk exposure.
Thank you, Richard, for this. Steve, anything to add?
So I will point out maybe two things. So the first is the environment is changing, and as liquidity becomes more dear, we've had to reevaluate some of the mechanisms that we use to be able to make payments. One of the things, and we started this, actually, it was probably now more like a half a decade ago, but we wanted greater insight into the payments that we were making. We knew how many payments we were making. We knew what our balance was at the Fed, and we knew how many payments we were sending through chips, and what was pending, what was not settled, where these transactions were coming from. But what we didn't have a real good feel for was the peaks and troughs, Carlos, that I had kind of talked about before. And one of the things that we discovered is that, and maybe it's intuitive, but maybe it's not so intuitive, our clients that are in Asia, they're going to start off the day, and for US dollar wire payments anyway, we open at 9 p.m. tonight for tomorrow's business. So 9 a.m. in Hong Kong, there's a whole bunch of payments that are coming through, dollar payments. Dollar's still very strong from a trade settlement standpoint. So there's a lot of payments that have to be made. The Asia clients need liquidity. They're making all these payments, and they're making them all over the world, right? They're paying Europe, they're paying the Americas, down South America, but all those banks are still asleep. So there's not incoming funds that are offsetting that. So we find a big bubble in the morning, in the Asia morning, where there's a bunch of payments going out, not payments coming in. They need liquidity during that time. And then as we do additional analyses, we could see where Europe comes online, and now we've got some equity there. What we did when we did this analysis is we tried to take a look and see a couple of things. We wanted to know, when we make a payment out, is there an expectation that we're going to get funds back from a particular counterparty? And as a result of that analysis, we looked and we saw, when we open at 9 o'clock on Fedwire, for example, while there are close to 8,000 participants on Fedwire, 250 are awake at 9 o'clock at night. They're up and they're sending transactions back, but there are thousands that are still not. They're not going to open up until their day starts in the US morning. So we try to rationalize the sending and the use of our liquidity at the Fed. Does it make sense to send transactions out if we're not going to get any more money back in, and if we know that they're not going to do anything with the payment when it gets there? The other thing we tried to do was rationalize the use of funds by clients. So for our Asia clients, for example, by the same token, if we knew that they're making a payment to a European client who wasn't going to be able to use those funds or pay anything out anyway until the European day started, do we need to make that payment then? Maybe what we could do is reprioritize the Asia clients' payments. And instead of doing them on a first in, first out order, rationalize where they're going and reorder them where they can make maximum use and maximum impact. So the use of data really helped us to try and understand how we can make the best use of the liquidity we have. Does that make sense?
That makes a lot of sense. And in fact, in FNA, we work on that, and that's called intelligent liquidity optimization. And it has to do with studying what is studying each one of the commercial banks' data to get how they're receiving and making and sending the payments of their clients mostly, and to see how you can optimize that, which is reducing the peaks and decreasing obviously the drops. Because for you as a manager of liquidity, it's better to have it stable, right? I mean, you have less balance idle, and you would need to come up with less solutions to find a better way to make those balances profitable. So it's the best way around, right?
I like your name. We don't have a clever name for it.
Now you know it now. It's
Now
intelligent liquidity optimization. I can't.
But it's yours. I got to make up my own new one.
No. You cannot make it your own. It's on our page already. Okay, let's go to the next one. Richard, a report by McAndrews and Barton reports that CHIPS uses an extremely modest amount of liquidity to settle payments, and the average dollar is settled about 5 hours earlier than on Fedwire, as you just mentioned, and you mentioned at the beginning of our broadcast. How is this achieved?
So I think it really dovetails quite nicely with what Steve just presented from a bank perspective regarding the timing of payments, and goes back to the contrasting nature between Fedwire funds and CHIPS. On Fedwire funds, of course, all activity has to be funded in advance with balances in that master account, or reliant upon the Fed's daylight overdraft provisions, or perhaps reliant upon the sequencing of payments as noted. In CHIPS, in contrast, one can contribute activity to the network as soon as it is available, and let the algorithm perform its magic, if you will. That tends to accelerate the settlement of activity on the calendar, and contribute very, very positive value, therefore, for participants in recycling liquidity earlier in the operating day. And I think, from my perspective as an infrastructure operator, it enables us to deliver the value that Steve just provided in his prior analysis. I will suggest, however, that we are not satisfied with what CHIPS is able to deliver presently. We are always seeking to make the algorithm more efficient. And I would just observe that as complement to that analysis that you referenced by McAndrews and Barton, we also engaged F&A recently to conduct an analysis of CHIPS efficiency, both a benchmarking analysis to compare and contrast CHIPS to other high-value payment system platforms around the globe, and secondly, to contemplate how we can make CHIPS even more efficient. The benchmarking analysis was fascinating and quite powerful in that it allowed us to compare CHIPS relative to other high-value payment systems that had CHIPS volume routed through them. So our past comparisons were always constrained by comparing, say, CHIPS volume on CHIPS versus Fedwire on Fedwire, CHAPS on CHAPS, Target 2 on Target 2, et cetera. The F&A resources allowed us to compare all the other payment systems with CHIPS volume running through them. So there was a harmonization, if you will, in the analysis of the output, both in liquidity efficiency and performance. And the conclusions were very, very powerful in documenting the performance of CHIPS across all performance metrics. It was also very meaningful in highlighting some opportunities for parameterization changes that we think over time will enhance liquidity, and also in identifying opportunities for optimizing sequencing of activity, perhaps even from participants before it even gets to CHIPS, building on that optimization analysis that you just mentioned, Carlos. So as good and powerful as CHIPS is now, we see strong prospects to make it even more powerful going forward.
Thank you, Richard. And I'm very happy to see that we're doing great in that aspect of FMI life cycle. Thank you for that. Steve, something to add?
I'm going to say two things. So one of the things that came out of that study that was done, and Richard talked about the parameters at the end. The thing that we had to think about was the way the CHIPS algorithm works today is constant. It's every second you put something in there, it does an evaluation. It's going. Well, one of the things about liquidity is that timing aspect. What if CHIPS didn't go? What if they paused and maybe did it every 50 seconds or did it every 2 minutes? Would there be an advantage? Would we be able to net off more transactions and then better maximize liquidity? And I think that's one of the things that we're going to think about. And it goes back to that liquidity is having money when you need it. So this changes the timing, and maybe slowing the payment down a minute or a couple minutes has an advantage. There's a benefit from a liquidity standpoint. The other point that I'll make, and Richard alluded to it, was the transactions that CHIPS doesn't know about. So what we found is that at least 10% of our transactions every day we know about in advance, sometimes a week in advance. Our client sends the transaction in with a value date in the future. They know they got to make the payment, so they send the payment order into us. We queue it. We're holding it. Well, what if CHIPS knows about them before the cycle starts? Then they can run through. That's 10% of the whole network value for that day. Maybe there could be like a super cycle, starts off the day, kicks everything in. I don't know. These are things we're thinking about. But if we have that forethought, if we could see those transactions in advance, we certainly can maximize our use of liquidity better, I think.
Steve, I think that you just mentioned several traits of intelligent liquidity optimization that we have at FNA by chance. Or One of them is changing like the dynamic of the algorithms, something like reorchestrating, like changing the dynamics of the algorithms. I mean, changing the order of the transactions as they arrive, but doing it in a dynamic manner. And second, for instance, if you already know of some payments that they're going to happen in 1 week, that communication between the FMI and the commercial bank, and the FMI knowing that that's going to happen, or to know it, that payment is skewed for 9 a.m. in the morning, that obviously is going to help the liquidity of the entire system a lot. And those are things that are being incorporated in this intelligent liquidity optimization that you already love without seeing it. So that was a good answer.
I will just let the panelists know that that was not a plant.
It wasn't. Not at all. And I know that my fellow FNAer Jeremy who is the owner of the ILO, the Intelligent Liquidity Optimization Solution, is very happy if he's seeing it. If he's the broadcast, he will be very happy. So let's go to the next one. I think we all agree that providing access to liquidity savings makes the efficiency of payment systems higher. But perhaps you don't know, I worked 16 years for the Central Bank of Colombia in the oversight department of payments oversight department. And we always had this question of, yeah, it's very nice to make the system very efficient because of the liquidity savings. What about the financial stability part? And that's something that Richard already mentioned. Is it safe for financial institutions to rely on high levels of recirculation of funds during liquid and illiquid times? Stephen, what do you think?
I think Richard should go first, so I can think about it.
Okay, the owner of the FMI should do it first. Okay, Richard.
Sure. So I'm going to suggest that there is great financial stability value from a liquidity savings mechanism in a financial system, Carlos. And I'll suggest even there is a bit of an Achilles heel of an RTGS, that in moments of crisis, participants tend to pull back and conserve liquidity. And that tendency in a moment of crisis can actually exacerbate the crisis a moment. And I think we saw evidence of that during the great financial crisis of 2007 and 2008. I will suggest that the liquidity savings mechanism actually allows participants to continue to contribute payment activity to a network without necessarily adding incremental liquidity to support those payments, and to allow the power of the algorithm to continue to operate to support activity in a moment of stress. We do validate every day the ability of chips to operate very efficiently based upon only the contribution of initial funding to the network without the need to add supplemental funding. And we think that this is a very, very meaningful attribute of chips from a financial stability perspective, in addition to a liquidity efficiency perspective.
Thank you,
and
Richard.
hopefully I gave Steve enough time to think there.
Well, you gave me something also to think about. I mean, that was, yeah. So Richard, I think that aspect of the 2007, 2008 crisis, that's a very good point, very valid. I can recall during that crisis, we had a mechanism that we put in place where I had been to throttle payments to distressed institutions because of our concern about use of liquidity. And the advantage of a network like the clearinghouse is that we see the inbound. We know that the credits are coming in and we've got a comfort level. There's an umbrella of stability that we have within the network to ensure that the payment flows are going to continue and come through. I don't know that it would obviate the need to have that throttling mechanism, but it does provide an extra level of comfort where you've got that transparency on inbound that might be coming out. There's a lot of value in that, I think.
That's
So,
really
Carlos,
interesting. I didn't know that. For instance, I worked for overseeing the RTGS system of Colombia many years, but I didn't know that that in some systems you could see what is coming. I mean, and to see it, no, I knew that you could see them coming, but I don't know if you could see them in real time and to make decisions about it. Yeah, it's really, obviously, from a financial stability perspective, to avoid those drains of liquidity if there's a financial institution in problem, or if there's not too much liquidity in the system, it's good for you to be able to check all those. I mean, to have all the data available to make decisions, right? So that was very interesting. Next one is fast payments. And we were talking about immediate payments and all these real-time things. Fast payments are becoming the standard for retail payments worldwide. As these are P2P and P2B payments, typically wholesale liquidity saving mechanisms, as those we know for RTGS system or ACH, perhaps are not that adequate. And in the sense of, it's very difficult to net payments or to do like a deferred net settlement mechanisms intraday if there are just a few, let's say, agents interconnected that you can net. That's the whole point in these P2P and P2B payments. How would you see that systems could optimize liquidity in fast retail payments? Retail is the key here. Stephen.
This one I can go first. Yeah,
I'm going to make you go first on that one.
Yeah, okay. Carlos, the first thing I'll throw out there, when we talk about retail payments, for better or for worse, they're smaller. So when I'm paying you, I'm not paying you like it was Merrill Lynch paying Lehman Brothers. You know, the average size of the transactions from a value perspective provide us with a comfort. You know, we don't have as many, they're not as big as they're coming through. And the advantage there is we don't need as much liquidity to be able to get those transactions that come through. Now, the flip side of that coin is that as a retail client, I want those transactions when I want them. So I want them over the weekend. I want them at night. You know, I need them all the time. As a commercial institution, I might not, because we're not working all the time. So we may not need it all the time. That overnight and over the weekend and over the holiday aspect does create a liquidity challenge. And certainly as the magnitude of retail clients use a particular payment network, the overall value of the amount of liquidity that's needed rises as well. There are two key challenges with this today. The first is having a predictive capability to know what the amount of liquidity you're going to need when you can't move it. So over the weekend, you know, we're gonna plug our funds into the account that's going to be funding the retail payments over the weekend. How can we guarantee that the payments are going to come through? We put it into this mechanism. Data will help with that. And as the new payment systems are being adopted, we're going to get a better picture as to how much is going to be needed or when it's going to be needed. The second aspect of this, and I know the clearinghouse is very actively working on this, the Federal Reserve is working on this, will be the adoption of the movement of funds in the real-time payment environment over the weekend and 24 hours. So the adoption of a 24-hour cycle, the adoption of a 7-day accounting cycle for the infrastructures that we use. Once that comes into play, that makes it a lot easier for us to ensure that we've got money where we need it, when we need it. You know, when it freezes today over the weekend or freezes over a holiday or freezes because the payment system cutoff time is not 24 hours, then we can't move money. We got to just make sure that it was there, that amount was there. So the last thing that I'll leave you with is that in the interim, while we wait for that 7-day accounting cycle, you know, while we wait for 24/7, I think there may be the opportunity for infrastructures to build in a lending capability. So way back in the day, when Richard and I started doing chips, and Richard was at the Fed at the time, I think, the way that the clearinghouse used to work was based off bilateral agreements. And there was a time when participants had to put up collateral, U.S. treasuries that were held by the clearinghouse as security on the payments that they were made. Perhaps as we're moving down the road with these retail payment systems that have to work 24/7, there may be the opportunity to create that type of safety net where you may not have all the money in your account when you need it over the weekend, but maybe you can borrow it. I'll leave it with that.
Thank you, Steve. Richard.
So I would just observe as complement to what Steve has rightly shared, that there is still a lot of low value activity that traverses high value systems. And over time, I think it's probably natural that volume migrate to the new real-time systems that are starting to hit the market. I will note in that environment, I think that a high value system that continues to have a liquidity savings mechanism at its core still has a comparative advantage over one that does not. And we think that CHIPS is very well positioned for the future as a consequence.
That's a really interesting take about this. Yeah, perhaps, I don't know if the word is right, but merging the large value and the retail payment systems, perhaps it's a way to make the liquidity savings greater at the end.
You know, this is maybe a very futuristic, consideration, but let's look, 10 years down the line. And there's sometimes discussion of platform convergence. Maybe activity in the future enters an organization like the clearinghouse, and maybe rather than getting routed via chips or real-time payments, maybe it gets routed based upon, does it require immediate real-time settlement, or can it benefit from liquidity savings? And maybe it gets routed left or right based upon those considerations, rather than the current names of the platforms, if you will. So we'll see how things evolve over time, but it's going to be a fascinating progression.
Should be like routing by demand, something like that. Now I have a new name for the product, Steve, routing by demand. Okay, let's go to the last one. We're getting closer to the Q&A part of the broadcast. And this is just to close like all this discussion about what's coming. And as Richard said, well, let's think about 10 years time. We have evolved from deferred net settlement systems to RTGS systems, which is what we have today. And then we progress from RTGS systems, and now we have RTGS combined with liquidity saving mechanisms that are akin to dynamic intraday DNS, which obviously all the point of this is to reduce the demand for liquidity. What do you think comes next? Stephen, let's start.
I think one of the words that Richard just used in his last response is critical. I think there's going to be a convergence. There is a loss of efficiency in having multiple payment networks to do the same thing. All we're trying to do is move money from one place to the other. And I think what will evolve, and we'll see how it has to come, but I think what will evolve is the movement to a single mechanism to be able to move money. There's advantages and disadvantages to different payment types. And there's reasons why, you might in the US use a check rather than using an ACH, or use real-time payments rather than using a wire transfer. I think that those reasons are going to smooth out over time. And really, we will see an evolution into maybe not a single payment type that we have today, but maybe a combination or a hybrid type that everybody uses to make all their payments. And I think that the evolution towards the type will begin as we start to move cross-border too. Globalization is vital. Today, we get a lot of wire transfers are doing cross-border. We're going to see real-time payments that are going to be doing cross-border. And as cross-border comes out, I think there's going to be a winner of a particular type of payment mechanism.
That's great, Steve. That's a great idea. Single mechanism, smoothing of the reasons for having different type of, let's say, conduits for liquidity settlement. That's really interesting.
I know this was a little fluffy. That was a little fluffy, but
no, but that's how great ideas start, right? Richard.
So that platform convergence that Steve mentioned, I think is very much in the cards over the long term. But maybe I'll just bring it in a little bit to complement what Steve shared with a more immediate sort of next step consideration. We want to take a very powerful liquidity savings algorithm and make it even better in CHIPS, both through those parameterization changes that we've referenced today and to contemplate sequencing optimization. And we think we can deliver even more value for participants and the network through those means. We also want to lever more aggressively that virtuous circle that we referenced. As we know through simulation analysis and from empirical experience, that the more volume contributed to the network, the greater the value in efficiency we will collectively receive. And one of the concluding references from that McAndrews and Barton study was that there is unexploited value yet to realize in the financial system with respect to liquidity efficiency. And we want to exploit that value over time, also by adding more volume from existing participants and also attracting new participants. So we think that there's extraordinary opportunity on the horizon. And we believe strongly that based upon the economic benefits, the liquidity savings and financial stability benefits, and also the customer service and risk reducing benefits, there's great opportunity still to exploit here from CHIPS.
That's great, Richard. About the new participant, that sounds like wholesale CBDC type of thing. If you have all the reserves accessible on the central banking accounts on the wholesale dollar, let's call it like this, available to more participants, the ability of CHIPS of making the payments or the liquidity more efficient should increase, right?
Well, maybe that's a subject for an entirely new broadcast, Carlos. I'm not sure.
I'm going to jump to the Q&A, and I'm going to start with the same subject, Richard, which is CBDC. And I have a question from the audience, which more or less, there are two questions. One is, how has the surge in digital payments affected liquidity savings? But I'm going to add it to another question, which is, how would CBDC affect liquidity management in FMIs and commercial banks? Perhaps commercial banks, let's leave it to Stephen and Richard for the FMI part. What do you think?
Well, since we're focused on liquidity today, let me, make an observation with respect to the CBDC or crypto use of liquidity. I view those, nascent instruments as operating very similar to a conventional RTGS with respect to liquidity management, and therefore being, liquidity expensive, if you will, relative to the liquidity savings that is embedded in a payment system like CHIPS. So that there are lots of angles here to explore through CBDCs, but from a liquidity perspective, I will suggest that they sort of operate like a conventional RTGS, very liquidity expensive. Steve, I'd welcome your views on that.
I would agree, Richard. In my mind, Carlos, and as Richard pointed out, this probably could be a topic for another webinar. The government-supported CBDCs are really a mechanism for the unbanked of that particular jurisdiction to have an account. If we look at the U.S. money supply today, 96% is already digital. So we're only talking about that cash portion for somebody who doesn't have an account. So as the Fed evolves their thinking into what they're going to do for CBDC, is that going to be, this an account at the Fed? Who knows? We'll see. They're still thinking about it. But
great. Yeah.
Go ahead, Carlos.
No, go ahead, Steve.
So I was going to switch then and talk about that commercial bank aspect of the the digital payments. I think what we've seen is a rationalization of the use of liquidity that we have across different payment types. We're going to now need a bucket for RTP, for example, and now we're going to need a bucket of liquidity maybe for FedNow next year as they start going live. We need liquidity for faster payments in the UK today that we support. We got to use liquidity for a SEPA instant. So we've got different buckets of liquidity across different currencies that we need to maintain for the hours when that RTGS system or the high value payment system is not working. So when that for us from a treasury standpoint does require a lot of thinking. Where can we put these buckets of liquidity? As we, and BNY Mellon is very active in this, as we expand our portfolio to incorporate additional payment mechanisms like blockchain and the digital coins and stable coins, as we investigate those, as we invest in them, that will drain liquidity as well. There'll be different pools of liquidity that we'll need for those.
Thank you, Stephen. That was very, very interesting as well. We have 3 minutes. I'm going to give you a couple of more questions from the audience. What are the panelists' thoughts about new digital global networks like Finality, RTGS Global, or the regulated liability network? Who wants to go first?
Richard.
I feel like I feel like school teacher saying, "Okay, Richard, you were not paying attention. You answered that."
Carlos, could you repeat the question one more time?
That's fine. What do you think about these digital global networks like Finality, RTGS Global, or regulated liability network?
So
challenger FMIs, let's call them generally.
This could be another webinar as well. I'm going to take one aspect of that, and first I'll just suggest there's tremendous innovation going on across the space, and all this innovation makes us collectively better as an industry. So I think it's very, very vibrant and to be encouraged. I'm going to suggest that one domain that is especially sort of prominent in our consciousness right now at the clearinghouse, and Steve referenced it earlier, was the cross-border and off-hours space. So a lot of some of these innovations endeavor to address the cross-border and off-hours frictions that currently exist. And from the clearinghouse perspective, one long-term strategic theme that we have at play presently is to expand the operating hours of chips ultimately to 24/7, and also to standardize our message formats in accordance with the global ISO 20022 standard. And I will suggest that organically, we hope to advance both of those themes to address some of those existing inefficiencies that some of these other, new entrants and new technologies are endeavoring to address.
And that's the key point, Carlos. I think that's the key point. I would say that these new infrastructures now, and BNY Mellon is not hesitating to invest in new ways of making payments, but they have to have a use case. There's got to be a purpose behind them. What are they addressing that the existing infrastructure doesn't have? And if it's got a good purpose, then it will get legs, and there'll be people behind it. There'll be payments behind it, and we'll invest in it.
Thank you, Steve. Thank you, Richard. This was a really great broadcast. Thank you for joining us. We are already a little bit past the hour, so thank you both, and thank you the audience for being here today. In the previous slide, we had like the get in touch information, just in case you want to get in touch with Richard, or with Steve, or with FNA. So I would like to thank you both, and I will invite all the audience to follow the next FMI broadcast next month, also the CBDC broadcast coming next week, and also the Subtech broadcast, which is coming next month, if I'm not wrong. So thank you all. It was a pleasure having you here, and I think that we'll have a new conversation with you two guys about CBDCs and things like that, and the impact on FMIs. I think that would be a very nice intersection between these two subjects, FMIs and CBDCs. And I'm the moderator for both broadcasts, so I think we can do that very easily. Thank you both for being here. Have a nice day, everyone.
Pleasure.
A pleasure,
Thank you.
Carlos. Thank you.